Well, April was nothing short of eventful. Not only did we experience one of the harshest declines in global stock markets since the pandemic, but we also saw one of the largest single-day gains in history. Despite the ups and downs, markets ended the month close to where they began. This should serve as a reminder to all investors not to get caught up in day-to-day volatility or attempt to time the markets. U.S. trade policy has shown that it can change on a dime. Prudent portfolio adjustments aren't really geared towards short-term reactions. Bellwether strategies have been holding up very well for a number of reasons. Broad diversification across geographies, industries, and individual companies. Exposure to private securities, which by their nature tend to be much more stable than public markets. And our emphasis on income generation, an attribute that is quickly becoming more important to investors in such an uncertain climate. As volatility ramps up, it's reassuring to know that a portion of returns are locked in and not subject to daily market fluctuations. April introduced another interesting development, a sharp decline in the value of the US dollar relative to most major currencies. The Trump administration's policy book, particularly around tariffs, has certainly damaged the US's reputation as a pillar of safety and stability during times of crisis. It seems like global investors have started to reallocate capital away from America into other countries. In fact, many global stock markets have dramatically outperformed the US so far in 2025 as part of this regional shuffle. The Canadian dollar has also had an active month, increasing roughly 3 cents or 4.3%, a sizable move for a currency in such a short period of time. Given that the depreciation in the US dollar dampens the performance of US securities for Canadian investors, our investment management team has been debating whether this trend is sustainable or not. We don't see the recent rise in the Loonie as a sudden improvement in Canada's underlying fundamentals. Commodity prices, especially oil, have generally been declining as fears of a global slowdown mount. While many of our exports have been spared from Trump's tariffs for now, our country's dependence on exports to the US leaves our economy highly vulnerable. It's worth remembering that many Canadians are still struggling with higher mortgage payments, so households are already under pressure. Finally, despite the fact that the Bank of Canada held interest rates steady at their most recent meeting, we think they are likely to lower them sooner and more dramatically than what the US Federal Reserve will do in 2025. All three of these factors could put downward pressure on the Canadian dollar. Given the recent federal election in Canada, we think it warrants commentary. In general, there was very little reaction to the Liberals winning a minority from our stock and bond markets, as well as the Canadian dollar. This isn't overly surprising given that politics in our country aren't typically known as market movers. However, we do think that the ability of Prime Minister Carney and his inner circle to negotiate with our stateside neighbors will become more and more important in the coming weeks and months. Tariffs are obviously a major threat to our economy, and we simply won't be able to forge ties with new suppliers and customers in other countries fast enough. The intention to do so is good for the long term, but in the near term, it's not easy to create new trade lines on such short notice. Adjustment periods aren't always convenient, but they're usually for the greater good. It's pretty clear that the US wants a new trade agreement with Canada and Mexico, so this will become a central issue for investors over the coming year. Eyes will also be on the Liberal government to see how they attempt to strengthen relations across all provinces, as well as how they address the growing budget deficit. In short, election results weren't immediately impactful, but their importance will grow over time.